Hello all and welcome to my YouTube channel where you can learn about the stock market. It's been a long time, I think more than a week. I made a first video on stock market training course, but now onwards you will get definitely one or two videos in a week. Most traders lose money because they don't follow a structured system. So I'm going to share my own customized trading strategy which I use for intraday swing and positional trades. This strategy is built to help traders identify high probability entries, manage risk smartly, and stay consistent. Whether you trade intraday, swing, or positional setups, the core idea is simple: trade only when the market structure and price action align as per the strategy. And this is like a orientation class for this strategy. I'm going to let you know four important things in the market: risk management, trading psychology, trading plan, and the market analysis. These are very important in the stock market. I'm going to start with the risk management because without proper risk assessment and management you will not be able to survive longer in the market. Risk management means protecting your trading capital by controlling how much you can lose on a single trade and making sure one bad trade doesn't wipe out your total account. Even the best traders lose sometimes. As we all know, market is very sensitive and respond to the all kind of news which is pertaining to the market and financials all over the world. So without proper risk control, a few bad trades can destroy months of profit. So risk management helps you to survive long enough to learn and improve, reduce stress and while trading. And the key elements of risk management which you need to be keep in your mind: risk per trade, stop loss, position sizing, risk to reward, diversification, avoid over trading. These are the very important things in the risk management. Never risk more than 1 to 2% of your total capital on a single trade. For example, if you have 1 lakh rupees in your demat account, then risk only 1%, which is 1000 rupees maximum loss per the trade. That means even if you lost 10 trades in a row, you will only lose 10% of your total account. And the stop loss is a pre-decided point where you will exit the trade automatically if the price goes against you. It's your safety net. It prevents emotions from the taking over. For example, if you buy a stock at 100 rupees and decide to risk 5 rupees, your stop loss is 95 rupees. That means your maximum loss is 5 rupees only per share. And position size means deciding how many shares or lots to buy based on your risk amount and stop loss distance. Example, if you risk 1000 rupees as I mentioned in the risk management section, then your stop loss is 5 rupees away, right? So 1000 divided by 5 is 200. So your position size is 200 shares. Always aim for a trades that can give you more reward than risk. Minimum 1 is 2 ratio. Risk 1 rupee to make 2 rupees of profit. That way, even if you lose 50% of trades, you can still be profitable with this kind of calculation. And never put all your money in one stock or trade. Spread risk across different trade sectors or strategies so one failure doesn't damage everything. And finally, trading too often leads to increase the risk exposure and emotional mistakes. So only take trades that match your setup and plan. Because successful traders think first about how much they can lose, not how much they can gain. Risk management doesn't make you a millionaire overnight, but it ensures you to stay in the game long enough to succeed in the stock market. And now coming to the trading psychology. Trading psychology is the study of how your emotions and mindset affect your trading decisions. Your success in trading depends 80% on psychology and 20% on strategy. Even if you have the best strategy, it won't work if your emotion control you. Fear, greed, impatience, and overconfidence can destroy profits faster than the bad analysis. So, proper trading psychology helps you to stay calm and disciplined, follow your trading plan consistently, control your emotions during wins and losses. Think logically instead of emotional trading. And fear makes traders exit trades too early and avoid trading good setups, hesitate to enter after past losses. So trade with a plan and fixed risk. When your risk is small, fear reduces automatically. And greed makes traders to hold winning trades too long. Take too many trades also. So double positions without any kind of logic. So stick to your target and risk reward ratio. Always think the next trade will definitely come. You don't need to catch everything in the market, right? And after a few wins, traders start thinking that they can't lose and take huge risks. That's when big losses hit. So overconfidence is also not good for the market. Stay humble that every trade as a new trade. Follow the same discipline, win or loss. And after a loss, traders try to win it back quickly, usually with bigger positions that often leads to more losses. So don't do over trade or don't do revenge trade. The solution is to take a break after a loss, analyze what went wrong, and then go ahead again. And traders who can't wait for the right setup often enter random trades, which will lead to definitely in losses. So wait for the confirmation. The market rewards patience only. And now trading plan. A trading plan is your roadmap for trading. A set of written rules that tell you when to enter, when to exit, how much to risk and what to trade. It removes guesswork and emotions from your decisions. So without a plan, usually people call it as a gambling. So make a plan which suits your trading style and select your market first and then go for trade. And the key components of your trading plan must be in your mind while trading. Define why you are trading and what you want to achieve. Are you trading for short-term income or a long-term income? So having a clear good goal gives direction and discipline. And the trading style is also important. Choose the type of trading that fits your time and personality. Scalping, intraday, swing trade, positional trade, options, or whatever it is. Choose which one suits for you and decide which markets you will trade. For example, stocks, Nifty, Bank Nifty, Forex, crypto, whatever it is. What kind of market suits you well, decide prior to enter the market, okay? List which setup or patterns you will focus on. Example, you will trade only Nifty 50 stocks based on breakouts patterns like that. And entry and exit rules is also very important because few people definitely enter in the good market, good position also, and they might not be able to exit properly, so that will turn profits into losses. So define the conditions to enter a trade not based on feeling but on signals, especially trend confirmation using moving averages, breakout above resistance with volume, RSA crossing 50 upwards like that. So you choose and decide which one suits for your trading style. And exit rule is also very important in the market. This is where professionals differ from amateurs also. So plan when to exit before entering the trade. And I suggest you to maintain a trading journal also. So keep a record of every trade, entry, exit, reason, emotions and result. This helps you learn from mistakes and find what works best. If you maintain a trading journal, then you will definitely come to know what went wrong in the past and then you can't make that mistake again in future. So I highly recommend you to maintain a trading journal also. And finally, coming to the market analysis, which is very important thing in the stock market. Market analysis means studying the market to understand its current direction, strength and opportunities before taking any trade or investment. And two types of market analysis is there. One is technical analysis and one is fundamental analysis. Technical analysis is the study of price action, charts and indicators to predict future movements. So you can analyze candlestick patterns, trends, supports, resistance and indicators like RSI, MACD, moving averages, volume. So find what the price is doing now and where it might go next. All these things you will come to know using technical analysis definitely. And fundamental analysis focuses on the financial health and performance of a company or the economy. So you analyze company data, which is earnings, revenue, debt management, everything. And economic data, inflation, GDP, interest rates, news are all things covered in the fundamental analysis. The analysis also is there, which is sentiment analysis. This is about understanding the mood of the market. Are trades feeling greedy, fearful or neutral? You check news and media tone, FIS, DIS activity, volatility index, social media and crowd behavior. Everything will be covered in the sentiment market analysis. So sense how people feel about the market because emotions often drive short-term price moves also. So what I mean to say is these four things are very important in the stock market. Before you entering the market, you need to keep in your mind all these things perfectly, then you will definitely succeed in the market. I'm going to make you all learn my strategy first and then I will move into another segments also like options, futures and all from this YouTube channel. So I hope you like this video. I'm going to end this video here and I will definitely, as I promised, I will make 1 or 2 videos in a week definitely. So thank you so much and keep watching, and I hope you all like the content of this video. Thank you so much.